Okay, all right. So, I'll just start with the disclaimer. Just, as a compliance um, standard, we have to basically give this the requisite disclaimer as educational purposes only, but this information in this presentation should not be interpreted as tax, investment, legal, or accounting advice. This material has been prepared for educational purposes only and is not intended to provide and shall not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisor before engaging in any transaction. And like I always like to say, if you so choose to have Kel-Star Consulting and our strategic partners serve that role, we would be honored to do just that. So again, moving forward, for those of you who don't know me, I do see a few familiar faces or quite a few. My name is Kelvin Harris. My company is Kel-Star Consulting. I'm a financial consultant, wealth strategist, wealth advisor. I've been doing this over 10 years. Here are just a few of my clients over that time, some that you may recognize. Urban League, Howard University, Columbia University, Blacks in Government, QVC, Home Shopping Network, so forth and so on. Um, Over my 10 plus year career, I've been involved with probably hundreds of events all around the aspect of financial education, financial literacy, wealth creation, wealth advisory, real estate investing, basically all things business, money, and investing. I have a pretty solid background in that. I've had an opportunity to help a lot of folks, and here are just some of the events that I personally organized. So not even the ones that I've been invited to or podcasts or things of that nature. So this is something that I really am excited to present and all aspects with as it relates to business, finance, and money. Let's see, it's on. Okay. Um, earlier this year, I became an author. So feel free to check out my book, The Secret Tax-Free Savings and Investing Strategies. What's interesting about finance, there's so many facets, and you can definitely take any one section to kind of really see how far the rabbit hole goes. And a lot of these rabbit holes go very far. So I struggle to try to put the information together in bite-sized pieces so people can digest it without, it's like I don't want to be um, responsible, or I don't want to be one of those people who, what's the analogy, drinking from a fire hose, because there's a lot. So I take great pride in taking this information and encapsulating it so people can digest it. So with this particular book, I just kind of highlighted a few things, um, um, some of which a lot of stuff kind of overlaps, but definitely a good book to check it out. If you like audiobooks, you can do that as well. All right, so let's uh, let's get started. Um, who recognizes this image or this picture or this art? If you know how to use your emojis, go ahead and throw up an emoji or anything like that. Um, one of the things I like to do is really try to make this stuff relatable, because I think in the financial industry, that's one of the issues, is that, sometimes people can talk over you. Ralph says, yes. So this is the um, Lauren Hill's, I think one of her best products, The Miseducation of Lauren Hill. Love the music, love the songs, love her as an artist. But I got to thinking about the premise of that, The Miseducation of Lauren Hill. And what I have found, or my perception, of the many of the systems that we have in this country and society, a lot of them seem to have this underlying element of sort of miseducation. And, and I'm kind of show you where I'm going with that. Um, so I'm starting high level and I'll start to drill down. So when you think of things like, you know, um, our political system, we have a big election coming up, as everyone knows. But I just remember when I was growing up, I was told we live in a democracy, just to come to find out we live in a republic. I was under the understanding that, you know, one man, one woman, one vote. And later on, I find out this electoral college actually elects the president. So it's like, well, some miscommunication here. And then, we talk about our medical system, our health system. Most of the, um, you know, leading countries, healthcare and things like that are free. But we have people in this country, we go bankrupt due to medical bills. So, um, we look at nutrition, a lot of things. Sometimes they tell you something makes you ill, then the next thing they say, well, it's good for you. Our banking system. Not too long ago, I did an event talking about fractional reserve banking, where I was shocked to learn that our banking system doesn't really work like I thought it did. I thought I put my money in there and my money was in the bank where I put it. Just to come to find out, no, if I put $1,000 in the bank, that just allows them, totally legal for them to do it. But now they can loan $10,000 out and charge interest on that off of my $1,000. It's called fractional reserve banking. So when you go to the bank, and I think there's a Facebook post where Soldier Boy, another artist, he's complaining that he went to the bank, he deposited $100,000. He went to the bank asking for his money. They only gave him $30,000. He was like, "Where's my money?" And then the guy came on and said, "Soldier Boy, let me explain to you fractional reserve banking." So anyway, don't want to go too much in that, but I'm just talking about these systems that we have that don't seem to work as advertised. I don't think I even need to get into the legal system, the judicial system, the prison system. I don't. We'd be 2 hours just talking about that. So I'm not going to touch on that, but I just want to bring that up as a premise for me for where I'm going with this presentation. Obviously, I'm here to focus on the financial system, but what I'm here, yeah, The Miseducated Negro, Carter Woodson, that was a good book as well. Yeah. So um, I guess where I'm starting with this is I don't want you to be surprised if you hear some things or you learn some things that you haven't been taught, or you learn. I get a lot of, well, why haven't I heard this before in what I do? That's why I talked about the system, because there's a lot of things you haven't heard of before until you hear of them. So since we're here tonight talking about finances, I'm going to focus on a few things in the financial system that you may not have heard of before, but I'm going to bring receipts. So, this is not something this wacky guy on Zoom is telling me about. You can actually go read the same books that I read. So, if we just single out finances, and under that category, I would say probably at the top of the list of things that we were miseducated about, my opinion, I would put life insurance at the top of that list. Because first of all, they don't educate us as if it's life insurance. They educate us like it's death insurance. I know how many people say, "Oh, you can only use that when you die." Well, I know why you think that way, because we've all been miseducated with regard to that. All right, so let me help you out a little bit. Here are just some of the books, not even close to all, that I read, I share with people, just to let them know this information has been out here for a little while, for quite some time. So when you ask me, Kelvin, why haven't I heard of this before? I don't really know why you haven't heard of it before. I have some, I have my own thoughts on that, which I will hold to myself for right now. But I'm not sure because these books are everywhere. I mean, you can order any one of these books on Amazon right now in the next 2 seconds. Tax free retirement, the power of zero, tax free income for life, bank on yourself. Coming back to that, become your own bank, money, wealth, and life insurance. I don't know if you can read the small print. How the wealthy use life insurance as a tax free personal bank to supercharge their savings. I don't think they, I can't make it any clearer than that. So all I'm saying is what I'm getting ready to show you today, if you're one of those people like me, well, where I used to be, where it's like life insurance, what are you talking about? Just let me kind of let you know you may have been miseducated around life insurance among many other things in the financial services industry. But we're only going to talk about that today because that's going to be a prerequisite for the topic, which is how to use it for investing in general, but real estate investing specifically, because which is another. It's like using life insurance to invest in real estate. What is that all about? All right. So again, I do encourage you. The book on the left, all of the books are good. Actually, these are actually not my favorite. The first two, Tax Free Retirement and The Power of Zero, I think are my favorite books. But these two books have the are the concept on which I'll be building today to make my presentation. They're kind of older, so a lot of the information is a little bit antiquated, but the concept is still accurate because the IRS and the insurance companies way some time ago made some agreements on how insurance is treated versus other financial products, which is why you saw that book about money, wealth, and life insurance, about how the wealthy like life insurance. But these two, you'll hear me talk about this, and hopefully you'll hear this more. The whole concept of becoming your own bank, bank on yourself. What does that mean? How do I become my own bank? All right, so let's kind of get into that. I had started calling cash value life insurance, index universal life specifically, the best financial product you never heard of. So again, it still goes back to kind of this miseducation or lack of information, however you want to characterize it. Um, and here's why I call it that, because again, you know, I showed you the books, but what I did basically is I'm summarizing, or I'm going to give you some of the bullet points of things that no one probably ever told you are characteristics or aspects of life insurance. Again, I guess you saw a little bit of my resume earlier. Been doing this for over 10 years, pretty much on a fairly frequent basis. I'm still learning about stuff that I'm like, wow, I didn't know that. So as I learn things, I like to share with the community. So here we go. Why do I call it the best financial solution you never heard of? One, okay. So forget about the title right now. Just look at the characteristics and tell me, is there anything on this list? If someone came to you and said, "Hey, there's a financial product that does this," you would say, "Oh, heck no, I don't want to touch that thing with a 10-foot pole." Okay, number one, your money grows tax free. Number two, your retirement income is tax free, unlike your 401k, your pension, and your IRAs, except for your Roth IRA. You never lose money. What kind of financial tool doesn't lose money? I think market goes up, market goes down. That's just the risk you have to take, right? Apparently not. So, but we'll get into it. You can access your money tax-free before 59 and a half. So for those of you who are like myself, who are 60 and older, this might not be that important. For those who are not, if you're not sure what I'm talking about, go to HR tomorrow and ask them, you know, if you pull some money out of your 401k, what would happen? They'll explain to you the 59 and a half rule. You can get market-like returns up to 13%. Okay, sounds good. I highlighted this for a reason. This is definitely going to tie into what we're going to be talking about today. This is one of the things I just learned not too long ago. And like I told you, I've been doing this for 10 years. Your contributions are tax deductible, but you have to be a business and a certain type of business also. Now, you can't just be a single member LLC, but we'll talk about that. Here's something else I learned. Your money is exempt from judgments, including divorce. In most states, let me give the caveat. California, only $15,000 of your money. So, which that means if you had money in this financial product and you unfortunately had a lawsuit, some sort of judgment against you, a divorce, whatever, the money, you can have $100 in there, you can have $100 million. That money is not subject to that judgment. Sounds like something that we probably should have known. Maybe before tonight. Your money is protected from creditors, including bankruptcy. I had to research that again because when I heard that, I said, I don't believe it. I said, but I did the research. I like to get verification from multiple sources in case one source doesn't know. But this is the case. Now, again, if I do I have one more? Oh, let me back up. So again, let's forget about the fact that this is life insurance. Is there anything on this list that could not be helpful or beneficial to most people? And if so, it seems like, back to my why have I never heard of this? I can't tell you why. Again, I'm in the business and have been in for 10 years, and some of this stuff I just heard about. So I'm not quite sure why this is not public information. It's not all over YouTube, but at least we're here now. I'll just say that. All right, let's move on. So again, now another component of life insurance, IUL specifically, I want to dive in a little bit. I'm not really going to make this a life insurance conversation. I'm going to make it more investment conversation and just show you how it is as a tool. But there is a specific or a few specific details that is going to make the conversation a little bit easier to understand. So that's why I kind of put this graphic together. And one of them is the secret of building tax-free wealth using life insurance. So this will probably be like the only life insurance sort of portion of the workshop. And the others are going to be mostly numbers, but I really want to help you guys understand a few things because I don't want you to get lost on the back end. So when we talk about life insurance and how it works, specifically cash value life insurance, we're not talking about term. So we're talking about basically whole life, universal life, variable universal life, and index universal life, all to a greater or lesser degree work like this. So essentially what happens is kind of like a cup. When you pay your premiums, that's how much you pay for the insurance policy. Again, this is everything except term. Term does not work like this. There's a minimum amount, they call it the minimum premium. So what you need to know is that only a portion of that goes to the insurance company. So when people say, oh, term is cheaper, my whole life, that's a lot more. Just understand, basically, insurance company is getting about the same amount of money as the term, give or take. It just depends on a lot of different factors. So, but that goes to them and under what we call the cost of insurance. There, and other fees are in there, so they get their part. But the rest of that money, the rest of your premium, the rest of what you pay monthly actually goes to who? You, as a part of your cash value. And it's like going into a savings account or a high yield savings. I like to call it your alive money. So when you're paying, generally you're making a payment and the permanent or insurance is higher than the term. Just understand you are doing what you are doing what a lot of financial advisors tell people to do, but you're just doing it through the mechanism of life insurance. I'm sure many of you have heard the term pay yourself first. This is what you're doing. Well, pay yourself first. Maybe you're paying yourself second because of course the insurance company gets there. But basically, you're paying yourself and the insurance company at the same time. So I guess you guys are tied for first. I don't know how you else want me to say it. But the important thing is, of that money that you're paying, you get the most. So maybe you're not paying yourself first, but you're paying yourself the most because the insurance company might get 30%, 40%, depending on age, health, those sort of things of whatever you're paying. So just keep that in mind next time you get a life insurance policy and it's a whole life cash value IUL, something like that. You're like, wow, this is expensive. This is more than the term that I bought. Just understand most of that money that you're paying is going to you. And where is it going? It's going into this high yield savings account where it will grow tax free. That's the important distinction. So um, give the insurance company their cut, the rest goes to you, and it grows tax free. Now, we still have a lot of room left in the cup. The cup has a maximum. So, like any other container, it's only so much you could put in there. But in this case, we're not even close to filling up the cup. So the question is, what happens if you put more money in than the insurance company is requiring you to? It's almost, just think of, I could pay my mortgage, or if I paid more, would I pay my house off sooner? I could pay the minimum on my credit card, but if I pay more, would I get out of debt sooner? I could pay the minimum on my life insurance, but if I paid more, would I build tax-free wealth sooner? The answer is yes. So if you put more money in, I'm not saying you have to, but you have the option to. That's called overfunding, or you'll hear people say max funded life insurance. This is what they mean. And the reason they say this is because everything you put in above the minimum, and now we already know a large percentage of the minimum is coming to us. Now, everything else above that, where does that go, Kelvin? Does the insurance company get some? Do we get some? What percentage? Well, I'm happy to report all that money goes into your tax-free account. So this is basically a workaround for people who are very interested in building tax-free wealth, which is what the slide said before. So all you have to do is figure out how to get this money into your cash value policy to basically leverage it, take advantage of it to build tax-free wealth. So I'm going to end it there, but I just wanted to show you guys that graphic because it's going to tie into the investment part. So this is one step in the ladder of where we're going with this. So this is how we kind of take advantage of growing more money tax-free inside the policy. But when we talk about investing, now the question is, well, now that I have the money in there, what else can I do with it? It's sitting there, it's growing. Maybe I'm getting a rate that I like. Maybe I'd like to get more. Excuse me, my throat is starting to get scratchy all of a sudden. So let's see how that works. So for the purpose, again, of investing with your cash value life insurance, and I put investors here because if we go back to the bank on yourself, excuse me, And we go back to the bank on yourself conversation. I just know a lot of my clients do real estate, and a lot of people I meet like to do real estate. So real estate is certainly something you can do, but you can invest in anything you want. If you like options, you like crypto, you like Turo, you like Airbnb, you know, you like stocks, bonds, mutual funds. It's kind of up to you. Um, so number one, tax-free high yield savings account. That's how we're going to leverage it, or how it can behave with regard to investing. Another thing that a lot of people may not know, when you have money inside of a life insurance policy, cash value, um, if you guys want to, I'm forgetting the actual code. It might be 7202, but there's some other one, the tax code. You can email me. I'll send it to you later. It's not, I'm not recalling it right now, but the general consensus is this. It says never use your money, borrow from the company. Small print. Your money continues to grow even after you borrow from your policy. So essentially, what the IRS has stipulated to the insurance company is basically this. Hey, if you have a client that has they have cash value in their policy and it's growing, and they want to borrow money to do whatever because there is no real stipulation as to what you can do with the money, we are mandating that you give them the loan not from their money, out of your general fund. Um, Best regards, IRS. So this is what the IRS is saying to these insurance companies. If they have cash value, because at the end of the day, that money needs to grow for them, but we just saw the vault. There's a lot of money in there growing tax free. Things happen, life happens. You might need emergency fund, what have you. Transmission goes out. You know, you got to get your dishwasher repaired, whatever it is. Put a down payment for your kids' college room and board. Life happens. What they're saying is, hey, when the client comes to you to borrow this money, don't have them fill out any application. Don't look at their debit or their debt to income ratio. Uh, don't look at their credit. What you do is up to 90% of what they have, they can ask you for a loan and you need to loan them the money, but not from their account, from your account. Again, so says the IRS. Thought that was, again, something that probably would be good for most people to know. Now, here's something I kind of just, this is a concept that I kind of piece together just with understanding the real estate and the life insurance component. When I really start to dig into it, I started to look, I'm like, wait a minute, this is something interesting happening here. So long story short, I know it's hopefully we have quite a few real estate folks on the line. I think I saw Nancy Alert jump on here not too long ago. If you know how to use a little emoji, please raise your hand if you're a real estate investor and you ever had to pay capital gains. I know it's not you. I know it's not a nice thing, but I guess the good thing is if you pay capital gains, that means you made a profit, which is great. Yes, I see. I knew Nancy was going to throw her hand up. So Nancy, well, I'm not gonna single her out. I'm gonna say I'll come back to you later, Nancy. But just I want you to think about when you paid that capital gains tax. Did the IRS, state of Maryland, anybody say anything to you about, hey, you know, we appreciate you paying the tax, but you know, we'll reimburse you for what you paid. Did they ever say that? I don't think so. So what I'm here to tell you is, if you understand how to structure these life insurance policies, and it's really not about structuring, it's really just understanding how they work. It's because it's a component of what it does, pretty much naturally. You can essentially get compensated for your capital gains if you're using it for real estate. All right. And then, of course, we talked about this earlier, but the money inside your policy is fully protected in most states. California, not so much. And there's another one I can't remember. I want not Connecticut, and it's not New York, but I'll get that one the next time. But definitely California. They got some little different things going on over there from the taxing perspective. But anywhere else, probably if you live in any of the other 48 states, your money is for that lawsuit, bankruptcy, and other judgment. We like to say it's judgment proof. Another interesting thing that a lot of people don't know. All right, so let's get into an example. Let me check my time to make sure we're on time. Okay, 7:35, so I'm doing good on time. Let's get into an example. So I'm gonna just do a high level before I get into the numbers. I like to do graphics. Some of you know my background is in architecture, so we communicate graphically. It's a way for us to communicate complex concepts visually where most people can understand. So I like to leverage that skill set for my folks here today. All right, so we got a life insurance policy here. A lot of times they represent life insurance policy as an umbrella. And what we're going to do in this scenario, so let's say we have a life insurance policy and a person is putting $40,000 a year. So one, two, three, a year into that policy. Now, in this case, it's either a max funded or close to max funded. Because why would you put that much money a year into a life insurance policy? Well, it's a couple of good reasons. So first of all, now I have $120,000 in my life insurance policy, most of which, if not all, I have access to my cash value. So the first answer to, well, why would you put that much money in? Well, if your business is tax deductible. So over the last 3 years, you just got to write off 40 off of your business. It's not off your personal. This is on your business tax. So that might be an incentive for someone to put that much money in. All right, but now I got all this money in my life insurance policy. What do I do now? Well, you run across a nice little real estate investment. It's like, oh wow, this is how much do I need to buy this? Or what's my all-in price, purchase price, renovation, closing costs, the whole thing. Let's say that's 100,000. And you're like, I got 120 in my life insurance policy. Should I use all of that? No, let's just use 50,000 because normally you can get access to 90 of it, but we don't want to we never really want to tie all of our money up into any one deal. I might have another deal that shows up tomorrow. So I'll put 50,000, which brings my account down to 70 inside the policy. From one aspect, there's another aspect where actually your 120 or so is still working for you. This is just the part that you can borrow. And then maybe I'll get a loan for the rest, a hard money lender or friends and family, whatever. I'll just get it from someone else. So I put in 50, I borrow 50, because I want to kind of keep myself as liquid as can, but I really like this deal. All right, so I finished the deal and I have this beautiful new property that is now worth 200,000. Just keeping the math real simple for everybody. Okay, cool. So now what happens? Well, first thing is, let me give the lender back his 50 and I'm going to pay me back because I borrowed 50 from my policy. So I'm going to pay that back. Let's see. All right. So I borrowed 50 from my policy. I paid that back. I paid the lender their 50. So so now I'm back to 120. The lender has his money, and now my profit is 100,000. And this is what we call in the industry short-term capital gains. We're assuming this is a flip. Okay, so I got to deal with this 100,000. I'm glad I made some money, but um, now again, I know we have write-offs and things of that nature. We're not going to get into all of that. We're just going to keep it simple for this conceptual idea or this hypothetical situation. So 100,000 in capital gains, federal taxes. We even talk about state. That's 22%. So right now, you're on the hook for about $22,000. Again, if you got a good accountant, can you get that down? Yeah. Can you eliminate it? Only way you can eliminate it if you maybe do a 1031 exchange or something like that. I actually don't like those because your money just keeps revolving. Well, I won't say I don't like them. It depends on what you're trying to do. Or maybe you take it and put it into a new project if you have one. But let's say this person does it. This was, hey, just a nice deal that fell in my lap. I couldn't resist. I made a quick 100,000. I'm happy, but IRS is happy too. They're like, yeah, I'm glad you made 100,000 because we get 22 of that. We're there. We love what you're doing, Kelvin. All right. So taking a step forward, so now we're saying, okay, what's the best thing to do with the 100,000? So let's say in this example, I'm going to take $50,000 of this 100,000, and I'm going to put that as an addition into my IUL policy because what we talk about max funding life insurance. So I have been putting 40 in. Now I'm going to put in 50, but the 50 is not coming from me, my 9 to 5. The 50 is coming from this investment I did because now when I put that in, well, one, now I have 170,000 in my life insurance with all those protections I talked about before, lawsuit, divorce, not going to lose money, tax free. So I have an incentive to put the money over here because I know it's probably as safe as it's going to be over there. Somebody can slip and fall in this next week. This money I have over here, they can't touch. This $50,000 that's floating out here. They might come after me for that, but they cannot touch the money that's in my IUL. All right, so I still have 50,000, and let's say we don't necessarily have to do anything specific with that. Maybe we pay off some debt. Maybe we put it down, buy a new car, put a deck on the back of a house, whatever. Help start pay for a wedding, anything. So let's say we're not necessarily investing that money. That money is just, again, pay off some bills, whatever. Help out a family member, whatever it is. So that money is spent, but I got 50,000 back in the policy. So now I started with 120. I got capital gains at 22,000. I spent that money, took care of some things, bought some clothes, bought a new car, whatever. I mean, it's my money. And but I have 170, so I can kind of rinse and repeat if I chose to do so. But also that 50,000 that went into the policy, let's assume it took us a year to do this project. Now for next year, I have another write-off because I'm assuming we did this project under an LLC. An LLC is a business. If you're a single member LLC, the function of having your premiums written off is basically through a strategy called executive bonus. I'm not going to get too far down the road into that, but just know you cannot just be a single member LLC. You at a minimum need to be a single member LLC recognized as doing taxes as a S corp. So if you don't know what that is, ask your accountant. I'm sure they'll be happy to tell you. Now I can write off the premiums on my life insurance if my money is coming from my business account. So I got a nice little stash growing here in my life insurance policy. And I'm getting a nice little business tax deduction, but I still have the the capital gains to deal with. So let's break down how we're going to deal with that, because Kelvin just told us a few minutes ago that this life insurance policy is going to reimburse us that $22,000. So he needs to show us what he's talking about. All right, so for those of you who have not seen a illustration, I just tried to simplify it, because a lot of these illustrations, they have a lot of numbers. It's very confusing, even for me, and I do this all the time. So I just try to simplify it to the best I can. So follow me as I kind of work through this. So basically, we're working with a person, in this particular case, a 47-year-old male. That's important because that dictates age, sex, health, those sort of things dictate the cost, and that all comes into play. But we see here that here's the 40,000 that he put in every year. But we see over here, this is our what we call our non-guaranteed surrender value. Not getting into the technical side, just understand anything under this column, this is where you can pull money out to do your real estate. This is where you can borrow. So anything under this column. So think of it, this column here is your money in the account. So that little vault I showed you before, that's this. This is the money you can borrow. So another way to, well, I thought that was coming up next. Another way to look at this, it'll show. Well, let me back up. Let me do one thing at a time before we get into that. So here's what you need to know. Most cash value life insurance policy, when you put X amount of dollars in, you are not able to access that same amount of money. You know, some of you on here have IULs from me. IULs are like vehicles. All of them have different, or they can be used for different aspects and different requirements. The example I always like to use is, if you got a choice between two cars. You got a Jeep over here and you got a Mercedes 7 Series, whatever, Mercedes. Which is better, the Jeep or the Mercedes? The answer is, it depends on what you're trying to do. If I'm going off-road in the woods and along some creeks with, some buddies of mine, Mercedes, as nice as it is, as luxurious as it is, air conditioning, leather, all that's not going to help me if I'm doing, or I'm going across, what's the Baja, going across the sand dunes and, and those sort of things. I need a vehicle that's conducive for that. So nothing wrong with a Mercedes. It just is not meeting that particular objective. Now, if I'm driving across country, long trip, I want to go in luxury, nice, quiet, smooth ride, I probably don't want a Jeep. Nothing wrong with a Jeep. The Jeep wasn't designed. Both of them are cars, both of them are vehicles, both of them have engines and a wheel, but they have different characteristics. No life insurance is the same. There's no one size fits all, but what's great about the industry is they're designing products to meet the need of the clientele, which is what they understand is some people want IULs, and they might be focusing on tax-free retirement. They might be focused on the health aspect, lifetime income, long-term care, living benefits. Great. You might not necessarily need the money up front. But other people, like business owners, hey, I would love an IUL, but what if I have a problem with payroll? Or what if I need money to mobilize for a new contract that I got? I might need access to that money. So the insurance company said, okay, look, we're going to create a vehicle that's conducive for what you may need. Now, the term you need to understand when you're looking for that vehicle is something called early cash value, which basically just tells you what it is. It means normally we wouldn't give you access to a lot of cash value because that's just how policies are designed. We want you to wait a little while, and we're really looking at mid and long term for most people. But for you business owners, we understand sometimes you guys need cash out of the blue. So we'll give you something called an early cash value rider, which will allow you to have access to 90% of all the money you put in there for whatever you want to do. We don't know your business. Again, you might need to hire some people. You might need to build out an office space. So we're going to give you for a limited time now. It's not going to be for the life of the policy. For the first couple years, let's say 3, all the money you put in, it's going to be 90% of it. I should have put a 90 here. 90% of this amount is going to be accessible to you for pretty much whatever you are. Now, year 4, we're going to recalculate. We're going to recalibrate. But hey, we want your business, so let's see if we can work something out. So now, from a conceptual standpoint, because it's a little bit easier to understand versus the life insurance jargon, what I want you to think of these columns as is this column is your equity in the policy. This is your line of credit. Almost identical, well, similar to a home and a home equity line of credit. Just in this particular case, with the early cash value rider, they're actually giving you an opportunity to borrow against more than you actually have. Can you imagine if you had a house worth $100,000, you had $100,000 in equity and went to the bank, and the bank said, "Oh, well, we'll give you a line of credit for 110 or 115." That probably will never happen in the housing industry, but it happens all the time in the insurance industry because, again, they have a little bit more flexibility around how they do things. Plus, they want your business and they want businesses. So it's like, well, hey, if we need to incentivize it a little bit because, we want you to be able to sleep at night to know, God forbid, I need some cash quick and all my money. This Kelvin convinced me to put $40,000 into my life insurance policy. What if I need the money? Here's the answer. You can get that money back. Also, the line of credit this is also kind of what we call the cash surrender. So the other aspect is if for whatever reason you needed to cancel the policy, and this is pretty much unheard of, within those first 3 years. So this line of credit is also basically the cash surrender value. So meaning if you cancel in the first 3 years, you get your money back. You get all of your money back. That's what cash surrender is. That's just the first 3 years. So probably don't want to cancel, and of course, if you get all your money back, now you got to go back to your accountant when you wrote off those taxes to say, yeah, we got to readjust because I got all my money back. But I'm saying all that to say their flexibility is there. You're not boxed in a corner. Because again, they want to design, if you need a Jeep, they're trying to design a Jeep for you that you can utilize for what you need. Maybe you already have a Mercedes. Like, again, some of my clients on here have IULs already for the retirement and the safety and the tax-free growth and wealth creation and generational wealth. We got that part. Maybe we use this for something else. All right, moving on. So under that same scenario where we talked about earlier, we're going to borrow $50,000 from our cash surrender value, i.e. line of credit. So now oops, why is this not? Oh, I'm hitting the wrong button. Let me back up. We borrow 50,000. So now we have 70 in our line of credit. Now, this is where I was telling you, your money grows even if you borrow. So technically what happened here, what you notice is this number didn't change. Now, it's not quite 120 because this is really representative of how much money you actually have. This is the life insurance company just extending you some additional funds because, again, they want your business. But if you really want to see how much money you really have, you're going to look at this number. Why? Because, out of here, they're actually taking the premium out. Somebody's got to pay for this policy. I told you in the beginning, it's the cost of insurance. They get that, and you get the rest. So what they're doing is just they're temporarily extending you some credit. Okay, we have this amount, but we're going to give you more credit because for the first 3 years, because hey, who knows what's going to happen in the first 3 years, your new business, what have you. But this money in here, this is what is accruing interest. So that number doesn't change. So they lent you $50,000 out of their account. So they're just reconciling here. So that means at the end of the day, if you were to cancel year 3 and you say, "Hey, you owe me 120,000," no, we don't, because we loaned you 50,000. So you can't cancel and keep the money we loaned you. So we're gonna give you 70. But if you don't, this 118 is going to continue to uh, accrue interest for you while you're out doing this real estate deal with this money. All right, so moving forward, let's say the next year we finish the real estate deal, so we got our $100,000 profit. And so, like I said, we're going to pay ourselves back because we borrowed 50. We just paid ourselves back. And then we're also going to put another 50,000 in here, because where else am I going to put it where I can get the kind of return I get here tax free and is protected, and I can just kind of rinse and repeat. So if I put the 50 back plus another 50, so that should be 170 plus interest. Why do I say plus interest? Because while I was out with this $50,000 doing real estate, my money was still in here, still accruing interest for me as if I had never taken anything out. That's why that number didn't change. So in this aspect, we're going to get about somewhere in the neighborhood of $2,000 or so, and it's 2,100 because it's 170 plus 2. Now, this might not seem like a lot, but understand we hadn't paid any premiums for this year. So they had to take that, whatever interest was made, had to pay the premiums for that year, and then whatever was left they put into our account, and then we basically paid everything back. So the tool is working for us and basically keeping us from getting to a position where our policy is going to lapse. All right, so here's where let's say in this scenario, so let's say we just do this one deal, we don't do anything else. And I already told you that we had that $22,000 capital gains that we had to pay. So again, if we just stop here, we don't put another dime into this policy. You see premiums for the next 1, 2, 3, 4 years, 0. Kelvin said, this policy is going to reimburse me for my capital gains. Well, that's what's going to happen, because here, as you can see, if you do the math, where the initial premium, because we put 50,000 in, so we can't count that. The interest we received was that 2,000, so we're going to add that in. But the next year, if I take the difference, 172, 149, and 178, 437, which is the interest on this product. The reason we know there was no interest because there was no premium, so it can't be anything other than interest. I just got $6,000 that year for pretty much doing nothing. Next year, I got another 7,000. The next year, I got another, because you see this number is going up. This number is going up. So in 1, 2, 3, well, if we don't count the year 4, because that's when we finished the project, but we count the interest. So 3 years later, our life insurance, our money, our cash value inside the policy basically put an additional $22,000 in our account. So this, the difference here and here is 20-something thousand dollars. So that we effectively got reimbursed for our capital gains. Now I show it this way because Could we have done more deals? Yeah, absolutely. We could have been doing deals every year. But in order for you to actually see how the policy works, the underlying ability of the policy, I didn't put any more premiums in here. So you can see this is strictly from what the policy is creating, the tax-free interest that is putting into the policy. We're not doing anything. We haven't paid any premiums. We're just letting the policy do its thing. Tax-free growth inside the policy. So again, this is the policy paying us back the capital gains. Now, some of you might say, and we're going to take a little break here in a minute to maybe take some questions, because I got one other part to go over, and then we're going to wrap it up. But here's what I would like to say. So if you're on there, say, wow, okay, wow, but it took me 3 years to get my money back from the capital gains. I think I'm gonna call Miss Nancy Alert. Are you still with us? I see your picture. Okay, maybe she's not with us right now. Who can I call on? I see. I'm looking for my real estate investors. Um. Oh, there's my man, Joshua Chandler. Joshua, how you doing, sir? Can you are you in a place where you can unmute? Maybe not. Who else?
Hey Kevin, what's going on, man?
How's it going, brother? Let me.
Oh,
So you're a big time real estate investor, right?
I wouldn't say I'm a big time real estate investor. I mean, me and my wife, we got the warehouse, but we're in the process of moving, and potentially, we have a strategy of trying to go into the tax deed auction and making some things happen.
Okay, but you've done some real estate investing.
Essentially,
Yeah, okay. Have you had to deal with any capital gains?
no. This honestly, to be frank with you, my wife and I were just talking about this. Once we sell this house, then yeah, we'll you know be in a position where we have to deal with capital gains taxes, but outside of this scope, no.
Okay, no problem. Let me do this. Is there anyone on the call? I know Nancy was, but maybe she might be in the middle of something. Lori, she's always doing some interesting things. Lori, can you hear me? Are you in a spot where you can unmute? Uh, maybe not. Maybe not. So
Yeah,
here,
well, I'm here, but um, yeah, even though I'm three in right now, my answer is three in. Me, I got three properties now, but my answer is no. I have not that I'm aware of, but I operate under this different space between the IUL land as well as
the tr
the trust.
the trust. Okay.
Yeah, but that's gonna be a deep dive for me listening to you today. Where I'll have to have a conversation with my CFO. Like, let's look at that and let me
Yeah.
make
Well,
sure I'm
well.
doing something.
Let me put it this way, because we got the trust. I'm not going to get on the trust. I've been just, and I know we've talked about this before, just really looking there. There's some people have this misnomer that somehow trust gets you out of paying taxes. I'm here to tell you they don't. And I can bring you a line of accountants that tell you the same. But I guess my point is this: if you were to pay capital gains tax, and someone would tell you, or I told you today, Lori, I'm going to give you a check today for capital gains taxes you paid 3 years ago. Would
Oh, okay,
you
okay,
would,
I'll
would
take
you
it.
would you take the check, or would you slam the door
Yeah,
in my
yeah,
face?
yeah. I take the check. I take the check.
What?
I'll
But it's
take the
three
check.
years ago.
That
What?
doesn't matter. If you owe me some money, I want
You're not gonna say where were you? Why you took so long? You're not gonna say that?
it. Yeah, I guess yeah. But right now at the gate, I'm listening to the fact that you got money for me and I want it. Okay,
Okay.
so keep going, keep going.
Yeah, no, I got you.
Because
But yeah, so
somebody made some money off my money is what you're
you
trying to tell
you
me.
you
But they
but
do
you
that
get
every year anyway.
but yeah, you're making my point, because what I'm saying is There is no magic bullet. There's just strategies. So my whole thing, short of, and capital gains is a reality that all real estate investors at some level have to deal with. You can either pay the capital gains and not get reimbursed in 3 years, or pay the capital gains and get reimbursed in 3 years. The only thing that's not a variable in that conversation is you're gonna pay them capital gains, or you have to you're gonna have another situation. So maybe I'm answering a question that nobody asked, but I just, I want to make it clear that, again, it's not this is not an instant gratification sort of thing, but basically understand every on a 3-year delay schedule, what you're basically your life insurance policy is compensating you to a greater or less degree. Again, it depends on how much money you have in here. But we know this column doesn't change if you're doing multiple projects. So just think like 3 years later, for every year, you're basically getting compensated because that money is continuing to grow, and it's basically putting back into your policy what you had to pay outside of your policy. So I thought that was pretty interesting once I kind of dived into that. All right, so we got one more. Okay, we're doing good on time. I'm actually in early, which is pretty much unheard of. All right, so let's look at this scenario another way, where I'm talking to some clients who want to put in just a lump sum because they have it for whatever reason. It came from a settlement. It came from they got a bonus at work. They already sold a property, paid the capital gains, and they still have some money left, and they don't want to go through that situation again, or they want to have a strategy. And so let's say instead of putting the 40,000 in every year, they have a lump sum of 20,000. Now you can kind of do the same thing, but there's a few little things you need to be aware of. You have to move a little bit differently, but it's definitely a advantage to using the life insurance. So, all right. So in this case, year one, the 120 is dumped in. You see there's that 118 that it took us 3 years to accrue the last time. We're starting off with that right off the bat. But you'll notice the life insurance policy, I think we were 5 something before, is like 1.5, over $1.5 million. This is something we got to be aware of from a strategic standpoint, because the premiums on a $1.6 million life insurance policy are more than triple the premiums on a $500,000 life insurance policy. So it's not, and the reason why this is, let's go back to the cup I had, or let's call it a bucket or what have you. The bigger the bucket, the more money you can dump in. So a bucket where I can dump in $120,000 at one time is 3 times as big as a bucket that I can put $40,000 in every year. That's why the policy amount is the way it is. Nothing wrong with that. The good thing is we have a really large life insurance policy. So now if we, get sick, stroke, heart attack, Lou Gehrig's disease, some kind of arthritis, we have a chronic, critical, or terminal illness, we have a lot of coverage there, because again, we're talking about life insurance. We understand if we pass away, our family gets that, but truth be told, most people, whenever they have a health event or accident or catastrophic event, most people don't pass away. They continue living. It's just that their capacity is diminished. So that 1.6 million might come in handy if there's some health challenges that I'm dealing with. But again, we're not here for that today. We're trying to do real estate. But it's good to know it's there, but I'm gonna have to deal with that at some point. Again, so if we look at it like, okay, here's our equity. So again, we don't have as much equity in the product as we do the line of credit because they've extended us some additional credit because they want our business. That's why they came up with this early cash value policy because they know there are people out there who may need to access their money sooner than a typical policy. But we're going to do the same thing. We're going to borrow the 50,000 from, and we're going to get it from the general account from the insurance company. They're going to reconcile our line of credit to say, okay, now the only thing you can only borrow 70,000 more. We're not going to change your equity. Your equity is still good. And then we finish the deal that next year. We get our 100,000. We pay ourselves back. We pay the premium, and now we're kind of back to that 170,000. But now, if we try to do what we did in the last policy, where it's like, well, hey, let me just stop here and let my policy build cash value for me. It's not going to work out quite as well. Why? Because even though we have the same amount of money in the policy, our premiums are 3 times as much because our policy size is 3 times as much. Now, we really don't see it because they're taking the money out of the equity in our property. So they're getting paid. So our money here, this 118, this 165 is accruing interest. The insurance company is taking their premiums out of that. And then whatever's left, they're adding to our equity and to our line of credit, if there's anything left. So in this particular case, we're short $204. So they took the interest, they paid themselves the premium, and since we're short $204, they took it out of our equity. Next year, same thing. We created more interest. We're making like 6% or so on this $165,000 inside. So they're taking that interest, paying the premium. They're like, oh, you came up short again this year, 280. Next year, we really came up short, 654. So we see that number is starting to go down. Now, at some point, some of the fees, they kind of waive them. But we're still not making that much. And we don't want our policy to go down because look at our line of credit. We started off at 170. Now we can only borrow against 164. So that's not ideal. It's not the end of the world, but we're definitely going in the wrong direction from a having access to money standpoint. So why we want to do that. So I'm simply showing this to say, for my clients who are looking to put in a little more money up front, what we really want to be committed to and understand is the conversation we had on earlier about now we're in a position we really need to use this policy like our own bank. We are going to become our own bank because we're putting large amounts of money in there and we don't want to lose that. So we need to know how to behave within this product to actually now use it as a bank. Because there are fees associated. We like the fact that we got a large policy. We like the fact that we were able to dump a bunch of money in there and get a tax deduction for it. We like the fact we were able to pull money out without having to do a credit check, or if our credit score was 3, they still have to give us that money because the IRS said, hey, these guys have 120,000 in there. Yeah, you have to loan them money. You don't have a choice. So we like that. What we don't like is when we don't put any more money in, it starts eroding our wealth. We don't like that. So let's be more strategic, more intelligent about how to use this tool that we have, because there's a lot of stuff we like about it. This part we don't like. So what should we do? So again, if we have a product a financial vehicle that is going to give us all of these benefits from the slide I showed you earlier. Okay, so I have a product where my money is going to grow tax-free. I have a product where my retirement income is going to be tax-free. I have a product where I put the money in and I'm never going to lose any money in the down market. I can access it before 59 and a half. I can get up to 13%. My contributions are tax deductible for my business only. I'm exempt from judgments, including divorce and creditors. Should I put more money in or less? Should I have all these zeros in there? Because the question is, where are you putting your money now? And where are you putting your money where you're going to get all of this? Because if you have some place where you're going to put your money where you can get all this and more, please tell me, because I will put my money there. But as of today, I don't know any place that's going to give me this. So all I'm saying to my clients is, you don't necessarily have to put 120 or 50. Again, if you do real estate, if you continue to do deals, this is a non-issue because you're going to be putting 20, 30, 40, 50,000 into this policy. But this is just, again, under the assumption, hey, I do this deal, I don't do another deal for a while. What am I committed to? Well, let's put some amount of money in that will basically just enough to keep the policy accruing in our favor, but not enough for us to quote unquote break the bank. Now, the other side of it is, it's basically $1,000 a month, $12,000. We probably make more than that, or we probably have access to more than that. So to the extent we don't put more money in, we're kind of cheating ourselves because again, you saw the list. But let's just say, hey, let's just do a minimum number just to I won't say take full advantage, but take advantage of this tool. And let's see, what can we do as a minimum that will allow us to get to the point like the previous policy where our money just starts making money for us on autopilot. So in this particular case, we're looking at about $1,000 a month for the next 1, 2, 3, 4, 5 years. So again, if it's a client who can afford this easily, beautiful. If not, okay, we got to redesign into something you can't afford. Maybe we dumb it down, and you do, instead of doing 1.6, you do an $800,000 policy, something to that nature. Just let's cut all the numbers in half based on what you can afford. But in this case, let's assume the client can afford this. Because again, this $12,000 is going somewhere. It's just probably going somewhere where it's not going to be as beneficial as what I just showed you. So in this scenario now that we don't have zeros, we're still in year 3. So we're basically going to get the total sum of what we put in under our line of credit. After that, they kind of recalculate because they're like, okay, we've extended you this credit for 3 years. Hopefully you were able to leverage it. Now we need to kind of get back more on an even keel. So now we're showing the true numbers, 189 versus 189. But even still, as we are putting in this $12,000, we notice we're still getting a bump in interest. So we got an additional 780,000 on this one. And this is going to continue on an upward scale for quite some time. So I'm just showing you the difference between year 5 and 6 for a positive 14. Now you put in 12, so in essence you got about 2,000 in interest. In year 7, you put in another 12, you got another 2,900 in interest. But year 8, you haven't put in anything. An additional 3,000, 2,000, 2,000. Then it jumps up 10. You get 10,000 for a while. Then it goes back down to 9. But you're consistently getting tax-free interest into this product once you hit a certain amount in. So you don't have to continually put 120,000 in. If you can afford that, that's great. If you're doing deals of that size, I would say, yeah, put some, or maybe at least minimum 50%, because all that's going to do is just make these numbers explode. But at a minimum, to take full advantage of these benefits, the tax-free growth, the tax-free retirement, the protection, the judgment-proof aspect. Any money we put in here is going to have those characteristics, or it's going to the product is going to allow us to leverage all of those benefits. Any money you have outside of here, not so much. So again, as we look at it more from yes, I want to do the investment, but for those of us who maybe want to start at a slightly higher level and leverage both the investment side of it, but also the aspect of creating our own bank. Because now we started off with 120, we got to 232, but all these funds here have been added by our life insurance policy. We didn't put any money in. So now we have a quarter million, 300,000 that we can continue to invest or do, because again, this money we can access out of our line of credit, tax-free, question-free, penalty-free, no credit check, no debt to income ratio. So effectively, you have become your own bank. I can just borrow from myself for things that I need, both on the business side and on personal side. And to the extent, the more money I put in here, the more money I'll be able to borrow. But my money is always going to grow tax-free in this protected environment, in a judgment-proof environment where I can have access, and I'm going to get returns similar to a high growth savings account. All right. So we're at 8:21. We're going to stop right there. I'm going to come back to that. I'm going to take a few questions if we have any. Hopefully, you were able to follow that. So any questions, comments, concerns, feel free. You can just unmute and ask, and I will go over it again.
Okay,
so,
I got a quick question for you, Kelvin.
Who is that? That sounds
This
like
is Ralph.
Hey, what's going on, brother?
Good, man. Good. So, going from the equity to a line of credit is just as simple as asking for it.
100%. So great question. So this is how you access I'm using these terms to help people relate to how it works, because life insurance is eerily similar to real estate. Again, I could probably do a 2-hour seminar on that. We're not going to do that tonight. So I'm calling it line of credit, but this is some policies call it your cash value. Some policies call it your cash surrender value. Well, all of them call it your cash surrender value, but the wording. So if you have any amount of money in your cash surrender value, all you got to do is either call your agent, or you can call the carrier and say, hey, can you tell me how much money I have in my cash value? And they'll tell you, well, hey, what's your policy number? Okay, it's XYZ123. Okay, Mr. Moore, you have $170,000. Then you ask them, how much can I borrow? The answer should be 90% of that number. That's across the board, all life insurance policy. So so in other words, you probably know already what you should be able to borrow before you call, but you just want to confirm with them, because sometimes, you might have more in there than you think. That's generally what happens, because even if you have I'm just times 0.9. So in that scenario, they should say, Mr. Moore, you can borrow up to $153,000. How much would you like?
Okay.
Then you say, send me $50,000. 3 questions that they ask you. No problem. Do you want us to mail it to you? Do you want us to send it overnight? Or do you want us to wire it? And if you wire it, it's going to be whatever their wiring rate. That's the only three questions they're going to ask you.
Okay.
Yeah. Unlike the bank, if you go and ask them for $50,000 and they ask you, what are you using the money for? Which I always thought was a strange question.
Right.
But have you gone to the bank and they asked you that?
Sure.
I'm like, why are you asking me why I need my money? That's I gave it to you, bank, to hold it until I needed it. I need it now. So I don't get the question. But the life insurance companies don't ask that question
That's pretty
because
cool.
yeah. So yeah, it's pretty simple. Just to
Okay.
it's a phone call. And again, it might be, it's a 2-3 days, depending on, like you said, if it's overnight, you can have it 2 days. Wiring, I think it's 372 hours. And then mail, who knows with the US mail when it'll show up.
Is there any advantage to one of the over the other, like wiring it or mailing it?
Just I guess how soon you need it. And
Okay.
just, I mean, I know the mail has been some things I've thought was coming in mail, and sometimes it doesn't show up. I've had some clients where they've mailed them their policies and they don't get them. So I'm not a big proponent of sending checks through the mail.
Got it.
I would either overnight, but I always just wire it. I'll pay the $4. I'll pay the
Has
$5.
has anybody ever paid back more than what they owed? Like if I got it up to 189,000 and I paid them back 191, does that make what happens then?
Well, nothing really happened because whatever you pay back more than what you borrowed, it's going to go into it's going to be credited towards whatever your premium is for the
Oh,
year.
okay.
So
Okay.
let's say down here you borrowed 200,000 or something, and you pay back 250, which is more. So they're going to just put however much they're going to put the 200,000 back because that's what you borrow, and the 50 they're just going to say, well, there's no place for us to put it other than the premium.
For one or
So
two years.
they're basically going to use it. They're going to pay your premium, but in essence, it's really just going. Remember the bucket I showed you? It's
Hmm.
just going back into your line of credit.
Oh, okay. Okay.
Yeah,
So
because
it might increase the line of credit. It could
it's
increase
going
it.
to increase the line of credit.
Okay.
So yeah, the only time you'll get into a problem is if you put in more than what the bucket will hold. Then they'll tell you we can't put all this money in. We can
And
only put this much in.
did you say the line of credit is interest free?
Is interest free. Well,
No interest on my money?
no, oh no. So when you borrow it, you are paying interest. There is a small interest. So for example, this particular product, I think there's an interest payment of 5.2 annually, and I think they credit you back like 5% or something. So again, and that's actually a really great question. When we get too far down in the weeds, but the reason why these insurance companies even charge you interest, they really don't want to. Insurance company wants, I mean, yeah, life insurance company wants to sell life insurance. They don't want to be a bank. They don't have a problem with you being a bank. Mike, I see you. I'm coming to you in a minute. They don't really want to charge you interest. They could care less how much money you need. They just happy you bought a life insurance policy from them.
Got it.
The IRS told them, well, if you're not charging interest, it's not a loan. So they're like,
Ah,
okay, all right, we can charge them something, but we're going to make it as small as possible. Because again, we want to incentivize people to use our product. We designed this nice tool for business owners. We want people to use it.
got it.
So they really don't even want to charge you, but the IRS made them.
I understand.
Yeah. So,
That
all right.
makes sense. Yep.
Okay. Yes, Mr. Stewart.
Hey, Kelvin, good evening. And this is very insightful. I've heard about this, but I did not go through the detail that you went through, and it's it's very insightful. So you gave multiple examples of capital gains or having a business where it kind of works in your favor.
Mm-hmm.
So let's talk about okay, I want to use the money to put on the deck or to do something personal. And so what I didn't hear you or I missed it. How long do you, so if you did take if you did borrow against your own money, how long do you have to pay it back before there is a penalty?
That is
Because you,
that. I
yeah,
I'm sorry. Go ahead. Go ahead. I want to answer your question before you finish asking it.
I didn't hear you talk about that or I missed it because it always seems like you always pay it back before something happened. But
Yeah,
is
I didn't talk about that. I don't know when you jumped on, but I didn't talk about that because I guess what I started with is there are um, multifacets where of ways you can use these financial vehicles. That's one of the things that I really like about them. That's one of the things that's great about them. Just makes it difficult for any one conversation because I could talk about using it for your kid's college plan. I could talk about using it for any number of things. So it's kind of want to stay on message. So tonight we're talking about real estate. But to your point, if you wanted to, so let's go back to the other example because it's really, and that's what I said earlier when I said it's an investment, but um, it's also kind of a savings plan. So here's a prime example. So let's say at this point, forget about the fact that you did a real estate deal. Let's just say you borrowed $20,000, like you said, to put a deck on the back of your house. Forget these numbers up here. At the end of just say you borrowed $20,000 somewhere in here. What this is essentially saying, even if you don't put any money in, the characteristic of a life insurance policy that's cash value is that it grows your money tax free without you doing anything. If assuming you have enough money in there to cover the premium and then net you some additional funds. So in this case, it's same, meaning if you had borrowed $20,000 in 1, 2, 3, 4 years, your policy would have paid it back. But let's say you had borrowed, let's go back to the other one. Let's say you had borrowed $10,000 here. Well, you see, your policy is not making enough money to pay it back. So that means at some point, maybe next year to year, at some point, these numbers are going to start going down so quickly. Once it hits zero, your policy has lapsed. You no longer have a policy. And you don't have to pay the money back at that point. You just lose your life insurance policy, which means you lose your ability to borrow and do all those things and protect your assets and grow your money tax free. So the question is, when you borrow, you need to sit down with your advisor or your life insurance agent, have them do an illustration so that you can see, like, for example, if you're paying your premiums, unless you borrow like I said, 90%, you're probably not going to, your policy is probably not going to lapse. But you really need to run an illustration and ask, hey, if I borrow X amount, how long do I need to pay it back, first of all? Because in that other example, we didn't even need to pay it back because it was such a small amount. But as the amount gets larger, your agent will be able to show you how long it's going to take, more than likely, assuming you're getting a certain interest rate before your policy lapse, and then also when you need to pay it back. Because the real question to the when you need to pay it back is really this. Let me back up. Is really, what do you want? So, like in this particular case, this person is 65. So let's say we transition from the real estate to a retirement conversation. So the answer to when you want to pay it back is, well, how much money do you want when you hit here? Because if this number doesn't matter, you don't have to pay it back. But if you're banking on having X amount of dollars here, you need to pay that money back sooner rather than later, so that the interest can catch you back up to where you need to be.
Yeah,
When I have yeah, when I have my real retirement conversation, it's about how much money do you want at this date, at this age. 500,000, a million. So if I borrow money up here, that's cool. You need to pay it back, because this whole thing is based on you having $500,000 in at or $1 million at 65. You don't necessarily have to pay it back right away. You don't have to pay it back in the next couple of years, because again, nobody's going to report to your credit bureau. They don't. Insurance companies don't report to credit bureau. It's just that if you don't pay it back, then that money's not going to have time to accumulate tax-free. That's to the number that you plan for it to be at when you hit retirement.
Yeah, that I think I got it. This is a powerful tool. Hey,
Yeah,
thanks for explaining it.
yeah, definitely is some bells, and I mean some moving parts, but like I said, I try to simplify it for you. Any other questions?